How's it going, everyone? Today we're going to be looking at FICO stock. The stock is up 59% over the past year, and over the past 5 years, the stock is up 518%. We're going to look at their quarter two earnings from 2025, as well as their guidance for the rest of 2025 to better understand why this stock is doing so well. So we'll go right into their earnings presentation from Q2 of 2025. They had scores revenue year-over-year growth of 25%. That's their credit score aspect of their business. Software revenues was up 2% year over year, and total revenues has grown 15% year over year. Scores revenue as well has grown 26% quarter over quarter. So they're getting a lot of growth in their scores revenue. That's the main segment of their overall revenue at $297 million. Their overall revenue for this quarter was $498 million, $498.7 million. Compared to Q1, which was $440 million. So strong growth in overall revenue, as well as an adjusted EBITDA as well. You had adjusted EBITDA of $287.8 million compared to Q1 of 2025, which was $223 million. This was a really strong quarter for this company, 29% quarter over quarter growth in adjusted EBITDA. If I didn't say already, 22% year over year growth in adjusted EBITDA. So really great quarter for this company, as well as you had a GAAP earnings per share highlighted below at $6.59, next to where my mouse is. And you had a previous quarter in quarter one, which was $6.14. Quarter before that, Q4 24, you had $5.44. Really strong earnings per share growth for this company. This company is growing very fast. You can see the chart where their overall revenue is also doing pretty well. This was a very strong quarter for this company, a strong revenue growth, as well as especially with their adjusted EBITDA, a very strong quarter for this company. In terms of the revenue mix, you can see that scores makes up a large portion of that revenue, as well as their software aspect of their business, and professional services makes up a small sliver of that. But scores is the big thing. Their scores revenue is growing a lot due to more people being able to get mortgages now with the improving housing market, as well as more people looking to get credit cards. And anytime someone's looking to lend, most of the time these lenders are going, or to borrow money, I should say, most of the time these lenders are using FICO for their credit score. FICO essentially has a monopoly on credit score ratings. So this company is doing very well once the economy starts improving as well. You can see that for expenses, though, personnel in the dark blue at the bottom here makes up the large portion of their overall expenses. Expenses actually shrunk quarter over quarter from $260 million in Q1 to $253 million in Q2. So not only was this company able to grow their overall revenue, but they actually had a decrease in expenses too. And you can see that since most of their expenses come from personnel, that number has stayed relatively flat too. So there's not really much expenses that this company has to worry about. And you'll see that with their operating margins. It's not like this company really has to change much of their business or have a bunch of capital expenditure in order to grow their overall revenue. So this company is extremely profitable and doesn't have to invest too much to grow this company. Pretty much they just raise their prices, and that's how they're able to generate more revenue because they have such a good score model that all lenders want to use FICO scores. Anytime you've borrowed money before with credit cards, you can see probably they ask for a FICO score. So total scores revenue up 25% versus Q2 of 24. Business to business revenue was up 31% versus Q2 of 24. And then business to consumer or customer revenue up 6% versus Q2 of 24. And this was the big highlight I was telling you about with mortgages. Mortgage originations revenue was up 48% versus Q2 of 24. So you have to wonder, with the housing market starting to improve and more people coming into the market, if that will continue to lead to further growth in FICO. And I think once you see the guidance, you'll certainly probably believe that case. Card and personal loan originations was only up 1% Q2 24. So it seems to be that this company is very much growing from business to business and mortgage originations for those scores increases in revenue. We can take a look now at their free cash flow. You can see adjusted EBITDA rose very well over previous quarter, Q1 25. However, their free cash flow did decline for Q2 of 25. Take a look now at, we're going to look at their scores operating margin. Q2 25 scores operating margin was 89%. their operating expenses was $32 million on a total revenue of $297 million for Scores. You can see this segment of their business is extremely profitable. They have a very high operating margin, and it doesn't seem like this company really has to increase expenses hardly at all to generate more revenue in this sector. It's very much dependent upon the economy, especially when you're factoring in mortgages and how that affects their Scores revenue. So overall operating income Q2 25, $245 million. Great growth for this company. This company is doing very well. Now, going into their guidance, revenue for fiscal year 2025, they're looking at $1.98 billion in revenue. And in earnings per share, they're guiding $25.05 earnings per share. If we compare that to the previous year of 2024, they had $1.7 billion in overall revenue compared to $1.98 billion. So 1.717, or the case may be 1.7, flatten out. That was your overall revenue. So strong revenue growth year over year. And then earnings per share for the year of 2024, fiscal year 2024, was $20.45 compared to what their guidance is, $25.05. So you're getting a very nice growth in earnings per share. And if we just take a look real quick at the valuation, though, you're paying a price to earnings ratio of 92 currently and a forward price to earnings ratio of 82. It's an expensive stock. They're getting an F rating for valuation from Seeking Alpha. However, I'm not too sure if the valuation is really much to be concerned with. This company essentially is a monopoly, and this company is still growing at a very, very fast rate. Overall growth rate from Seeking Alpha, you're getting an A-, and overall profitability from Seeking Alpha, you're getting an A. So let me know in the comments if you think this company is a good buy, or you think it's extremely overpriced, or if you think that this is something you might buy. I personally own FICO. I'm not going to say whether or not I think that this company is a buy right now. It is certainly expensive. However, I do think the company has such strong fundamentals and a growth story behind it that I'm willing to hold this company. Let me know in the comments if you think the same. Thank you guys for watching. If you enjoyed this video, please consider subscribing. If you didn't enjoy this video, then don't subscribe. Thank you, and y'all have a great day.